keep hearing about the Smith maneuver and cash damming. What are these things? What's the difference? All right, fundamentally, let's talk about how this affects you, the Canadian taxpayer. So this part's a bit different than our friends in the States. Our mortgages come with interest payments, right? That interest that is charged by your lender for borrowing money. And our interest is not interest that can be deductible from your income when it comes time to paying taxes. Let's use a quick example. If you're American and you got a mortgage for $300,000 and your interest paid in 2024 was $10,000, your income is actually reduced by $10,000 because you have a deductible expense. So you're paying income tax on a smaller amount. So the effect of having deductible interest is you pay less taxes. In Canada, we don't have that. We do have an allowance for creating an interest deduction if we took out a loan for the purposes of an investment. So an investment in a business, an investment in real estate, it could be any investment, so long as it's reasonable that you took out money from a loan so that you can acquire or cover an investment. All right, so in Canada, we can't write off the interest expense that we pay on our personal mortgages. So that interest is called non-deductible interest. What the Smith maneuver and cash damming ultimately are trying to do is recognize that we are making interest payments in this category to our mortgage, and that interest is not deductible. Well, how do we convert that into interest that is deductible so that we can pay less taxes? That's it. So you got two common strategies in Canada to do that. All right, Smith maneuver came first. Shout out to Fraser Smith out in BC for creating this strategy. What happens here is you create a loan. In this case, your loan is your mortgage, and you borrow money from that loan to acquire an investment. So long as you can trace that investment to that loan, the interest is a deduction. That's it. So in the TLDR world, trying to overly simplify what's happening here, imagine you had like 50 grand and you can pay it towards your mortgage. Boom, you do that and immediately pull that money back out, 50 grand from the loan facility of your mortgage, and buy an investment of whatever type you want. So long as that money goes from the loan to the investment, you can trace this back and say, hey, I borrowed money from this facility so that I can make an investment. Interest is deductible. And if you keep doing this over and over again, you could probably replace all of your mortgage and the interest that you're paying there from non-deductible interest to deductible interest. It'll take a while, but you could do that using the Smith maneuver. Cash damming is a bit different. Ultimately, it's the same in that you're trying to create deductible interest, but the way you do it's a bit different. Cash damming typically is used for people that own an investment property, right? So you've got your business is an income property. Okay, so you've already got it. So it's not like you're acquiring it. And what you're doing is, as revenue comes in, so rent, you apply that to your own personal mortgage first, pay down your own mortgage, which is not interest deductible, and then you borrow that same money back out from the same mortgage to contribute towards the carrying costs of your business / your income property. The act of doing this is going to convert non-deductible interest into deductible interest over time. Every time you get a rent check, you pay your mortgage first, borrow the money back, and the act of doing this creates a deductible expense from your mortgage. The difference between the two strategies, one is acquiring an investment. You're going out there and you're investing in the Smith maneuver. Cash damming is more like you've got it already. You're just changing the flow of money and you're covering costs, the expenses side of the investment you already have. Ultimately, you're trying to do the same thing, convert non-deductible interest expense into deductible interest expense. The Smith maneuver requires that you buy an investment, which comes with its own set of risks because you're acquiring an investment and investments could go up and down. And cash damming is more of you got it already. You're just gonna change the way that money flows. When income comes in, you're gonna pay for it and you're gonna pay for the expense with borrowed money, which essentially is converting non-deductible interest into deductible interest. So there's no added risk, inherent investment risk on cash damming. Just a matter of what do you have? Are you buying an investment? Are you using one that you have? I hope that clears things up. We'll get wealthed up.